Hello. Welcome to the Hammer Museum. I'm Claudia Bester. I'm the Director of Public Programs. Pleased to introduce tonight's Hammer Forum on Capitalism in Crisis with Bill Lazonick and Andy Rappaport, and moderated by Ian Masters. So on to tonight's program. Our moderator is Ian Masters, who will introduce our guest speakers. Ian is a BBC-trained broadcast journalist who's covered national security affairs for over 25 years on public radio. He's the host of Background Briefing on Sundays at 11 a.m. and the Daily Briefing Monday through Thursday at 5 p.m. on KPFK 90.7 FM. Ian has been a senior fellow at UCLA's Center for Strategic and International Affairs and the UCLA Center for International Relations, and was a consultant to the Center for National Security Studies at Los Alamos Laboratory in New Mexico. So please join me in welcoming Ian Masters.
Thank you, Claudia, and all of you for coming tonight to explore the notion that our capitalist system is in crisis, with makers being replaced by takers. Our capitalists used to produce goods and provide jobs. Now, instead of creating wealth and spreading it around, more and more wealth is extracted and concentrated at the top. Gone are the days of Henry Ford and Thomas Edison, and welcome to the era of Jamie Dimon and John Paulson. Since the crash of 2008, many Americans have lived through their own crisis of capitalism, where, according to a recent study by the Federal Reserve, from 2007 to 2010, the average middle-class family saw their net worth plummet 40%. And while the bankers who caused the crash have been made whole by the taxpayer, the middle class is either still treading water or underwater. The vast Robin Hood in reverse transfer of wealth that led to the crash and Wall Street's subsequent reward from the taxpayers for monstrous failure isn't happenstance. The repeal of Glass-Steagall, the ideological blindness of Ayn Rand's most faithful acolyte, Alan Greenspan, and the revolving door called government sacks all contributed to the Great Recession we are now in. Academic studies have documented the growing dominance of finance in both the economy and in corporate profits, leading to spectacular increases in compensations for CEOs and managers in financial services, far outstripping the wages earned in other sectors of the economy. The current dominance of finance was achieved through what analysts call the financialization of the American economy. The term financialization describes two interlocking processes: a disproportionate growth in a country's deregulated financial sector relative to the rest of the economy, and the rising importance of financial activities with a focus on financial returns among industrial and other non-financial corporations, often at the expense of real innovation and productivity. The consequences of this are far-reaching for the nation. Financialization has produced extreme concentrations of wealth which, as we have seen, can be used to influence elected officials and government agencies tasked with regulating the financial sector. Former chief economist of the International Monetary Fund, Simon Johnson, has exhaustively documented how large financial services firms and investment banks influence the machinery of federal government, a process he calls the quiet coup. Other research suggests that the financialization of the U.S. economy was an indirect result of the opening up of global capital markets in the 1980s, a development that allowed Congress and every administration since the Reagan era to sidestep the federal budget constraints that confronted the Ford and Carter administrations in the 1970s, meaning that the financialization of the U.S. economy enabled the borrowing and leveraging of gigantic sums on a global scale. Some, like the Turkish economist Özgür Orenghazi, see the rising influence of the financial sector in terms of historical epochs, as he has described in his book, Financialization of the U.S. Economy, which identifies financialization as one of the indicators of the decline of the hegemonic power. He gives examples of imperial Venice, Genoa, Holland, and Britain, who all saw their power rise on the back of productive industrial capitalism, followed by domination by the financial sector, which eventually began to cannibalize the productive sector in pursuit of greater financial returns, a process that ended in weakness and collapse. Public awareness of the change in our economy away from a capitalist system that makes products and produces jobs to an economy increasingly dominated by a system based on the extraction of wealth that is concentrated at the top has been slow in coming. The Occupy movement, with its framing of the 99% versus the 1%, has highlighted the growing disparity in wealth and opportunity in the country, perhaps best illustrated by the fact that just one family, the Waltons, the heir to the Walmart fortune, have as much wealth as the bottom 40% of all Americans. And it does appear that the candidacy of Mitt Romney for president is having the unintended consequence for him of shining a light on this disparity, particularly when it comes to taxes, which he won't release, either because he is hiding something or because he is arrogant. While middle-class taxpayers are routinely audited, Mitt Romney has never been audited by the IRS, and undoubtedly this does not sit well with a lot of people, especially those who followed the recent study by the former chief economist at McKinsey & Company, James Henry, who did a report for the Tax Justice Network that found the global financial elite, which also includes criminals and kleptocrats, is hiding between 21 trillion and 32 trillion in offshore tax havens. All this idle money makes a mockery of the notion of wealth as the seed corn of capitalism that grows and nurtures new businesses and innovation. But rather, it leads one to ask the same question that Bill Gates' father famously posed: how can you sail 2 luxury yachts at the same time? Finally, in terms of a revolutionary backlash that history indicates follows periods of greed and excess, where are we today? If it turns out we are at the Marie Antoinette point of let them eat cake, with the revolution just around the corner, will it be bloody and nasty, or will a new progressive era emerge like that of the reformer and trust buster Teddy Roosevelt, who rode to the rescue after the last Gilded Age? One of the many questions to ask our guests tonight. William Lazonick will speak first for about 15 minutes, followed by Andy Rappaport. Then we will have a discussion between ourselves before extensive Q&A with you, our audience. William Lazonick is a professor of economics and director of the University of Massachusetts Center for Industrial Competitiveness. He is president of the Academic Industry Research Network, and his latest book, Sustainable Prosperity in the New Economy, Business Organization and High-Tech Employment in the United States, won the 2010 Schumpeter Prize. He's also a visiting scholar at the Institute for New Economic Thinking. Ladies and gentlemen, William Lazonick.
Well, thanks. It's great to be here, and I'm looking forward to this discussion. So I'm going to try to go through a big picture of what's wrong with the U.S. economy, or what I see as at the core of what's wrong with the U.S. economy, in 15 minutes. And it starts with a definition of, which was part of the title of my book, Sustainable Prosperity, by which I mean equitable and stable economic growth. So these are objectives, and I think you probably wouldn't have too much argument among most people, at least most sane people, that these are what you want to achieve. So you want to get real per capita income gains that can raise standards of living. So you do want to get growth. You want the gains to be shared out fairly among those who contribute to that growth. This doesn't necessarily mean equally. It doesn't ever mean equally, but it's equitably. And you want it to be stable. You want employment and income that are not subject to boom and bust. Okay, now the book that Ian mentioned gives some background to this. It's a very empirical book looking at what I call the demise of the old economy business model, which provided a lot of equity and stability in the economy and growth, to a new economy business model that a lot of it came out of Silicon Valley, highly innovative, but has in fact been one of the sources, not the only source, but one of the sources of a great deal of inequity and instability in the economy. And I'll explain why, hopefully, by the end of another 14 minutes now. Okay, and just to go back here, and a lot of it has to do with this thing called shareholder value. Now, if you look at the growth of per capita income in the United States over the last half century, you see that, in fact, now our per capita income, real per capita income, is about twice as high as it was in 1970. So whatever the problems are in the U.S. economy, it's not that we haven't grown. So you have to ask the question, why is the economy not working for most people? Well, there's a lot of instability. There's always been a lot of instability, but there's more instability. There's also been, in the last decade, a major slowing of growth. And right now, we're in what many economists call a jobless recovery. You might see it as a third jobless recovery, the first one after the recession of early 1990s, the second one after the recession of early 2000s. But it's actually really the fourth jobless recovery, because for blue-collar workers after the recession of the early 1980s, they didn't get their jobs back. Okay, now if you look at inequity, well, here's a measure of inequality, the Gini coefficient. If the Gini coefficient is 0, it means that every household in the economy has the exact same income. If it's 1, it means that one household would have all the income, no one have anything else. The Waltons, I guess, are trying to push toward that. Now, interesting, there's a professor here at UCLA, a colleague of mine, Chris Tilley, who with Barry Bluestone and Bennett Harrison in the mid-'80s wrote a book. It came out as a book by Bluestone and Harrison. Tilley was involved in the origin of this idea of a great U-turn, which you can see in the post-World II decades. You had a movement toward more equality, slightly, at least in terms of this graph, in the 50s and 60s. And by the early 80s, that movement was gone. So that was the great U-turn, but you hadn't seen anything yet at that point. The extent of inequality just grows and grows and grows. A lot of it has to do with the growing productivity and not being shared out by workers. So this is a graph, this comes from the Economic Policy Institute, of the divergence between productivity and the compensation of average workers. And this actually is a more complicated one, but it shows that women, who still get paid generally less than men even for the same work, have sort of got caught up somewhat, and it's really men's wages that have stagnated the most. Now, at the top, you have this. These are data that a couple of economists, Piketty and Sayes, have put together on going way back and looking at concentration in income at the top. It's as concentrated as it has ever been. So if you just take the top 1/10 of 1%, that's that bottom line, in 2007, it was about 12% of all income in the United States was the top 1/10 of 1% of income earners. Okay, now in the old economy business model, which I mentioned, you had a lot of equity and stability, mainly because people had jobs for careers with a company. So companies kept people employed over their careers. That was actually the expectation. That occurred right into the 1980s. There was very little role of the stock market in these economies. In these companies, it basically was a way of separating ownership control and putting professional managers in place historically. There was a very progressive income tax structure, although always lots of tax dodges. And the government played a major role in funding the physical infrastructure and the knowledge base. Now, the new economy business model sort of piggybacked on this and commercialized a lot of the innovations that had come out of decades of research by government, also by corporate research labs. And the stock market was very important in allocating resources away from the old economy to new economy in the early 1980s, particularly in Silicon Valley, basically luring venture capital to do startups because of the existence of NASDAQ, which was founded in 1971, on which you could do a quick IPO, and the use of stock options, which have a very long history but became very important in this period, the early 80s, for attracting people away from secure jobs with old economy companies to very insecure jobs with startups. Of course, some of those startups later became very powerful and well-known companies like Cisco and Intel and Microsoft. In the late 70s, it was really before Reagan, it was really the Silicon Valley interests that got together and said, we need lower tax rates. They were and that's what really initially tied the notion of low tax rates to innovation, and they were doing a lot of innovation. There's no doubt about it. At the same time, there was a lot of outsourcing within this model of manufacturing. It actually goes back to the 1960s, semiconductor industry. So there's a lot of jobs that were being done in other parts of the world. Now, if you have innovation, you actually can, this is where productivity comes from, you can have lots of different groups sharing out. There's no reason why you can't, and in fact, I would argue most of the times you should. But it hasn't been happening since the early 1980s, and a lot of this is government policy, But underlying it is a fundamental change in the business model that dominates the U.S. economy. So that's my basic argument. And capital is getting much of its return from the stock market. Labor getting significant income from the stock market, right up to the CEOs, but not exclusively the CEOs, but they still get the lion's share. And this is what fundamentally has changed, and I would argue will argue in the next few minutes, has made the economy highly inequitable, highly unstable. And here's a picture of it. And basically, I argue there are three drivers of stock prices: innovation, speculation. Many people will accept those, but the third one, which has become very important, is manipulation. Okay, in the 1980s and 1990s, you had companies that were like a Cisco, for example, that was reinvesting all its profits, growing, and its stock price grew because it was doing a lot better. Then you have speculation that starts going crazy in the late 90s. And that builds on the fact that people all of a sudden discover these companies have done very well. They want their share, although, and this was called, came first from Alan Greenspan, then from Robert Shiller, rational exuberance. But it turned out we now know there are a lot of insiders who were making lots of money, and it wasn't irrational at all. But the third thing, and this is the thing I'm going to mainly talk about because it's the big problem, is not innovation, certainly not speculation, but manipulation. That basically there are ways in which those who control the allocation of resources in companies can manipulate the stock market. And in the 1980s, they were doing it, old economy companies restructuring, getting their stock price up, laying off lots of people. In the last decade, and this really started in the 1980s, it's been something else, and it's stock buybacks. And stock buybacks aren't talked a lot about. I don't know how many people here have ever paid attention to them. They are, in my view, they not only reflect the fundamental problem of the U.S. economy, they are the fundamental problem of the U.S. economy, and hardly anybody is talking about it. You'll hear it here. Okay, here are just some pictures. I have to go very quickly on anybody. You had this boom in price yields of stock in the 80s and 90s that obviously couldn't be sustained, particularly if everybody was in the market trying to have their savings and their pensions being funded by the stock market. And within this context, however, you got an ideology that became dominant. I was at Harvard Business School in the 80s and saw it before it was there and after it was there, of maximizing shareholder value, which is one of the things, is the ideology that legitimizes taking a lot of money out of the economy by people who should be putting money into the economy. Now, here's stock buybacks, and this really became a major phenomenon in the last decade, which you can see between 2003 2007. The red line is S&P 500 companies basically pushing the S&P 500 index, of which they are components, up to a new peak in 2007 before the financial crisis. Okay, now this is some more detailed pictures built up from data, tracing it back for this about 300 companies from 2008 back to the early 80s. And you can see in the early 80s, stock buybacks were minimal, much less than dividends. Dividends have gone up over time, but stock buybacks have gone up even more. In 1997, they surpassed dividends as a form of distributing funds to shareholders, and then they ran wild in that period going up to 2007. Since then, they've come back down, but they're going up again. And if you just look at the decade, 2001, 2010, and remember productivity was very slow, good jobs are not being created. I'm going to talk a few minutes about what was happening and why they weren't being created. This is what companies, the major companies in the United States, the ones on which we rely to invest, and not just us, but a lot of small companies rely, were doing with their money. 54% went to buying back their stock, which is just to manipulate the manipulation of the market. We can talk about this more if you want. And another 40% to dividends. So you had about 6% of net income left to fund other things. Here's a list of companies that were the top 50 repurchasers over that decade. And I have a whole research agenda, which a lot of people are working on, looking at industries that you see here and the companies you see here to say what differences make. I can't even start talking about that. What I can say is that over that decade, these companies threw out $3 billion of money that they had in those companies just to get stock prices up. Okay, now, this is still going on. You can see these figures show that most of the, almost 4/5 of the S&P 500 companies are doing stock buybacks. This is the list for 2011. Now, who has an interest in stock buybacks? Top executives. Here is a picture of what's happened with the executive pay. basically, around 1980, which precedes these data, you had in the United States about 40 to 1 was the ratio of executive pay to the average worker's pay. And this is even today high by international standards. By the early 90s, it was over 100 to 1, and this is when people started talking about excessive executive pay. And you can see in 2010 dollars in the early 90s, the mean pay, let's say if you take the top 100, was about $21 million, 92 to 95. Most of that came from the biggest component is the actual gains made from cashing in stock options. Okay. Now, what happens? How do you make money with cash in stock options? You have the stock at exercise price. The price goes up. One of the things that's helped boost prices is stock buybacks. Now, if you look in 2004, 2007, the same group of people, but you can look at any group cut you want. It's in three times in real terms higher than it was back then. And this is what everybody knows about the explosion of executive pay. This is what it's about. It's about a stock-based pay, mainly from stock options, and one of the prime ways in which they're getting pay up, these top executives, is by manipulating the stock market. So you have in the late 90s, it was really the gains from speculation, but now it's much more manipulation. Okay, I show the same picture here, and some pictures which show how this shows up basically as in the top 1/10 of 1%. Now, companies, the top executives say, well, this is the greatest investment we can make because we have faith in our company. I say what they're doing when they're making that argument is they're not doing their job because they have faith in the company. They would investing in the innovation of the next generation. But in fact, once they make that argument, they will never, in fact, sell the stock at a higher price for the company because then they were saying we no longer have confidence in the company's stock. But it's executives who sell it at a higher price, and they make lots of money doing this. Okay, how do they reap where they have not sown? I'll go through this very quickly. They have compliant boards. They're made up of top executives who all have an interest in increasing their remuneration. They hire consultants who benchmark other top executives, who hire the same consultants to benchmark other top executives, who hire the same consultants, et cetera, et cetera. They get paid in a currency, their own company stock, that they can manipulate. Okay? Now, they get the SEC, the regulator or watchdog, to permit them to engage in manipulation. They get the SEC to remove any barriers to reaping the rewards of stock market manipulation by selling the stock as quickly as they get it when they exercise the options. And they legitimize all this by the most pernicious ideology that's ever walked the face of the economic earth, maximizing shareholder value. I could spend 3 hours talking about that. Okay, the SEC, very quickly. In 1982, they legalized manipulation. It's on the books of the SEC that stock buybacks by large companies, for Microsoft, it could be $300 million a day, which is legitimate. They will not be charged with manipulation. It's a safe harbor. It's been there since 1982. Then in 1991, they changed a rule which said that the top executives had to wait 6 months once they exercised the option before selling the stock, which of course meant they had to take risks the stock would go down. They got that changed. Okay. This is the only article that appeared that I've been able to find in 1982, a very good article in the Wall Street Journal, which says agency is assured that it won't file charges of manipulation if certain rules are met. That was the beginning. Okay, now why does this all matter? Well, it's not just the concentration of the income at the top. These are the companies that we rely upon to create good, high-quality, middle-class jobs. And they haven't been doing it, and they haven't been doing it on a large enough scale for 3 decades. And as a result, we have increasingly severe jobs recoveries. And this is what Ian referred to as the financialization of corporate resource allocation, by which most people mean the growth of the financial sector. But I said the real problem, the real heart of the problem, is it's in the industrial corporations, particularly, on which we depend to invest in innovation, et cetera. Okay, now, very quickly, I'll end with this and then some things we can do about it. This is what's happened. I mean, there's a very complicated picture, but I'll try to summarize it very quickly. Basically, you've had fundamental changes in the structure of employment, corporate employment in the U.S. economy since the early 1980s. You had the Japanese competition, plant closings in the 1980s, never reopened. You had marketization, by which I mean the end of career employment with one company. IBM was a central company doing this in the early 1990s. Now everybody has moved away from the notion of a career with one company. And then you have globalization, which has been around a long time, but really kicked in once you had China and India on the scene with a lot of people who could do the work done in the United States at much lower wages. Okay, and across all this, starting in the 1980s, however, you had this thing called financialization. Now, go on about, in a way, rationalization, marketization, and globalization were all necessary. It's not that you can do without them. They're all part of the changes in the economy that are necessary, but companies have made a lot of profits from these, and they've in fact pushed these phenomena further than they have to just to make profits, and then when they make the profits, they don't reinvest it in the next round of high-quality jobs that keep the United States prosperous. So they haven't been investing the gains in profits in new jobs, higher value-added jobs, and the technologies are there. The reason is financialization, and the major phenomenon is stock buybacks. So I'll just skip over this, the 1980 financial crisis. I have a whole critique of shareholder value, which I can get into, but I won't go into. I'll just get to end with what is to be done. Okay, what is to be done about employment? There should be regulations of the employment contract that ensures that workers who contribute to the innovation process share in the gains of innovation. A lot of people are being robbed when they work for a company for a long time with the expectation of sharing in the gains, and then some people can just lay them off. That's not an easy thing to regulate, but there needs to be some regulation of this, and other countries do it in various ways. There is a big problem that's totally undocumented, that there's a lot of wasted human capital, not just lack of jobs for young people, but people who have accumulated a lot of education experience, whose skills atrophy, and whose very valuable human capital is not being used because there is no recognition of this problem and ways of saying how can we use these for the benefit of those people and of society. And you need to have implementation on the gains from innovation to fund those government agencies that need to invest in the public knowledge base required for the next round of innovation. Now lastly, what's to be done about corporate resource allocation? Stock options are a scam. There is absolutely no performance criterion on this. You can have speculation, manipulation, make money, and that's what's going on. So if you're going to complain about pay at the top, look at what's going on, and I guarantee you most people who are talking about pay at the top haven't looked into how it's being done and the whole game that's being played. Ban stock buybacks. They're just a manipulation of the market. They should absolutely be banned. You can have some representatives of these other stakeholders, and this is something else that, for example, you do in countries like Germany and Sweden, which are doing quite well now, relatively. And ban this ideology of maximizing shareholder value, which if I had 4 or 5 hours, I could talk about a lot more. Okay, so you got to get rid of stock options, ban stock buybacks, transform boards, reject shareholder value ideology. What do we need to do this? Well, unfortunately, it will require a revolution in social norms, and hopefully you can have a revolution in social norms. I actually did see it in the 1980s because it went the other way, and I like to see it go away toward an equitable and stable economic growth. Thank you.
Andy Rappaport is a partner at August Capital, a leading Silicon Valley venture capital firm where he invests in early-stage technology startups across the spectrum of electronics, communications, and information technology industries. Prior to joining August Capital, he was president of the Technology Research Group, a Boston-based strategy consulting company he founded, and he has been a founder and/or an active director of more than a dozen venture capital backed startup companies. He also serves on the Dean's Council of the Harvard Kennedy School of Government, and with his wife Deborah oversees Skyline Public Works, a civic incubator the Rappaports established in 2003 as a means to further innovation in cultural and political activism. A member of the Patriotic Billionaires, ladies and gentlemen, Andy Rappaport.
Good evening. It's a pleasure to be here. My comments are going to dovetail very well with Bill's, but you're going to find them far more depressing, I'm afraid, because I think the problems, we're tackling the same basic question, but I think the problems are far, far worse and harder to fix. But the one thing I will say is I realize that I am the token taker here this evening, and I'm really glad that Bill doesn't have a pitchfork because I serve on corporate boards of directors. I've made a fair amount of my wealth through stock options, and so I feel a little threatened here. In thinking about the title of this of this evening's forum, Capitalism in Crisis, I realized, due respect to Ian, that capitalism is not in crisis in the United States. Capitalism, thank you very much, is doing fine. You can measure that through corporate profits, which are at record levels. You can measure it, as Bill showed, the economy as measured by corporate output is growing. So capitalism seems to be doing just fine. Unfortunately, I think it's society that's in crisis. And society is in very deep crisis because the forces that have led to symbiosis between capitalism and society in the United States for pretty much the entire history of the United States have weakened. They've weakened due to secular trends. These are not things that are temporary. These are things that are moving only in one direction. And as a result of that, capitalism is not working for society the way that it used to. And society, unfortunately, is not working for capitalism the way it used to. And we are headed towards some problems that are even more severe, I think, than the ones we face now. And what worries me most, as you will hear in my remarks, is either the inability or the unwillingness of society to be honest about, let alone tackle some of these problems. So let me start. I'm going to talk a little bit about what I see as the causes. I'm going to talk a little bit about what I think can be done about it. Let me start with a story. About a little over 20 years ago, I co-authored an article that appeared in the Harvard Business Review called The Computerless Computer Company. It was quite controversial at the time. And our thesis, and we wrote this article in 1990, it appeared in 1991. Our thesis at the time was that owning the means of production was becoming increasingly ancillary to recognizing value from intellectual property. And in fact, for companies that owned the means of production, it was very often more an albatross around their necks or an anchor around their ankles than it was a strategic asset. And we came at this. I was running a consulting firm at the time, and we came at this from the perspective of corporate strategy. But we basically said, look, the value increasingly is in very abstract, massless intellectual property in many, many, many industries. And, the notion that one has to tie oneself down with the means of production is outmoded, and increasingly value will shift to the owners of intellectual property, not the owners of the means of production, let alone the people actually doing the production. And we had a meeting with our editor, a very bright guy at the Harvard Business Review, when we were laying out the outlines for this article, and we laid out the basic thesis and what we believed the outline would be. And he just sat back and he said, "Oh, I get it. So what you're telling me is that in the future, the world is going to be run by a few," these were his exact words. He said, "The world is going to be run by a few Robert Redfords, and they're going to have all the money because they have all the great ideas, and the rest of us are just going to have to eat their crumbs." And I thought, boy, that's kind of extreme. Let's get on to this article. I got a business to run. But that has haunted me for 20 some odd years. And what's happened in those 20 some odd years? Well, for me, against the odds and surprising no one more than myself, I became one of those Robert Redfords. And from my position now and over the last decade or so, I've had to contend with what, as a celebrated quote-unquote job creator, what I actually do in my business life for the economy. And the answer is a lot less than people think, and I'll talk about why. And I've also had to contend with what is my obligation to society, and that's informed my wife and my philanthropic activities. But it's all because I've been haunted by that one remark. What's going to happen? Do people just eat the crumbs of those who control the value in intellectual property? Well, what has happened in the world since then, and in the United States especially since then, is self-evident. So we have the highest income inequality, as Bill just illustrated, that we have ever had, right? And we have that in part, I believe, and I'll explain why I think this has occurred, because of concentration of value in things that don't require work, right? So we've had this symbiotic relationship between wealth and work. Wealth has needed work in order to create more wealth. I think for the history of the global economy, this is starting to break down, right? And so if wealth no longer needs work to accumulate more wealth, then what's going to happen to the people who need to work, right? And so the reason I think society is in crisis is we're not facing up to that question. The income inequality is at its peak point now. The prior peak year for income inequality in the United States was 1928. We all know what happened in 1929, right? We all know what happened in the 1930s. We all know what happened in the early 1940s, and we all know the transformation of society through the New Deal. So when income inequality was at its prior peak, we stepped up as a country and we said, we have to solve the problems that got us here, otherwise it isn't going to get better. We have to do that now, but we're not even talking about the problems in the right way, in my opinion, let alone being honest about what it's going to take to solve them. So what are the problems? And, you know, it's going to be hard to fully depress you in my remaining 10 minutes, but I'm going to do my best. So I'm going to highlight three things that have led to, in my opinion, this disconnection between wealth and work. There are many, many more, but I'm going to highlight my favorite three. The first is, and I feel some responsibility for some of these things, but the first is a technology that has led to automation. Automation is wonderful from a productivity point of view. It has absolutely increased global productivity. But the thing that we don't think about when we think about the effects of automation is we don't think about the fact that what automation has done in many, many, many industries and continues to do now is it shrinks the difference between skilled and unskilled labor. Right? We use automation to substitute for things that used to require skills. There are all kinds of examples of this. My favorite is call centers, where it used to require very highly skilled technicians to diagnose problems, and now it doesn't because we have automated the process of question asking and answering so much that all it requires now to be a technical support person in a call center is the ability to know what question to ask next and read the screen that comes up. Right? That's all, and soon those people are not going to be necessary because we have automated systems that can do that. You can do that online and get the answers to your questions. And companies like it when that happens. So if we shrink the difference, the value difference between a skilled and an unskilled workforce, then as someone who is trying to create wealth through the assets I own, I no longer need to have a skilled workforce, which means I don't necessarily need a stable workforce, which means I can draw from workers from a much larger pool than I used to. And the strategic asset I used to have in the heart of the Industrial Revolution, my workforce, whom I trained and I'm going to employ for life, and they're going to be loyal to me because they know how to do the job, has gone from being an asset to a liability. It holds me back from buying cheaper labor somewhere else. Right? This is why, in large measure, labor unions have lost their power because labor unions used to negotiate on behalf of an asset that was viewed as strategic by their employers. Didn't always do it successfully, but the clearing price on labor contracts was always something less than the replacement price if everyone walked out. Well, if the replacement price is zero, there is no leverage. So that's one problem. The second problem is that thanks to improving communication and transportation technology, the idea that things have to happen in any particular locality has also disappeared. We can move goods around, we can move information around remarkably cheaply and remarkably quickly, which means that not only do I, as a business owner, now get to avail myself of very inexpensive, unskilled labor for most of the jobs I need to do. I don't need to invest in their skills anymore, but I can invest in it around the world. And I can find it where it exists in the world. And globalization, which I think is generally a good thing, has increased the pool of suitable workers and suitable places where those workers exist. So we now have labor as a global commodity. And if labor is a global commodity, we know what's going to happen. The value of any individual laborer is going to fall. Right? Now, I mentioned that this is a secular trend. I can't see technological forces that are going to do anything other than accelerate the rate at which this is occurring. So the third thing, and this gets a little bit to the financialization point that Bill just made, is that thanks to technology, thanks to reduced regulation, thanks to some incredibly clever invention on the part of a number of people in the financial services business, We now have industrial production of economically useless financial products, right? So it used to be that if I had a bunch of money and I wanted to invest it in something, I had no choice but to invest it in something that had some economic value, right? That did something that influenced the underlying economy. That is no longer true. I can buy derivative securities, and my purchase of derivative securities will have no direct impact on the, or only at the margin will it have any impact on the underlying economy. Let me explain this. I'm going to explain derivative securities very, very simply here. If I field a baseball team, right? I'm from San Francisco, the San Francisco Giants, right? You'll pardon me for that. And I pay players, and I have a game, and we're selling hot dogs, and we're collecting tickets, and we've got parking facilities, and we've got all these things happening. I am directly injecting value into the economy. I'm employing people. I'm doing all of those things, right? You could argue, is that a great business? Is it a lousy business? But I'm putting money directly into the economy. If I take the same amount of money that it takes me to put on a baseball game, and I bet that amount of money on a baseball game, that's a derivative product, am I doing anything for the economy? Well, at the margin, somebody's got to collect my bet, and somebody's got to. But you think about this, the same amount of money. You think about the number of people who are employed in that, in the industry that creates that baseball game versus the number of people that take my bet, right? The direct effect on the economy is fairly small. So my bet on that baseball game is a derivative product. What the financial industry's created, though, is they've gone one step further, and they've said, what if we take a whole bunch of those bets and we package them up into a security and we sell you shares, right? And, we'll tell you that those shares and all of those bets that all these people are making can outperform the market. And if they do for a while, you'd buy those shares, right? So we take a bunch of bets, we package them into a security, we sell you the security, and then we go from there. What I have just described, of course, is the roots of the current financial crisis, right? I just described how credit default swaps work. This is the aggregation of a bunch of bets. It is nothing more than gambling, right? So the effect of this is not neutral, right? Because I've just described something which isn't injecting any money into the economy. You say, well, it's not taking any out either, but there are two problems. One, it pulls money away from economically productive activity, right? If it pays more for me to invest in a hedge fund that's buying credit default swaps than it does for me to invest in Cisco, right, I'll do that, right? So we're pulling money away. Financialization pulls money away from more economically productive uses. The argument that the financial industry makes in favor is, but we're making markets more efficient, we're making the velocity of money greater, and that's reducing the cost for everyone. And unfortunately, witness A, or exhibit A for the prosecution here is 8.5% unemployment today and higher borrowing costs for business as a result of the fact that the high volatility of these financial products creates very short periods of low-cost money that are followed by very long periods of high-cost money. And so net, this is a drag on the economy. So if you take all of these things and you put them together, what's happened is that the self-interest of people with assets to invest no longer demands that they invest in things that are creating work. And in fact, there are many more and an increasing number of places to put money where work is practically irrelevant. And it doesn't take very long to puzzle that out and get to increasing income inequality and increasing aggregation of wealth among those people who already have it, among asset owners as opposed to workers. This is the problem that I believe we face as a society, and this is the problem that I believe we have to step up to. So what can we do about it? Well, I think that the answers to this problem fall into three possible buckets. So the first bucket is we can decide that we don't care, right? And there are actually two schools of thought about this right now. One school of thought says we don't have to care because if people can't figure out a way to profit from what's going on around them, shame on them. And, those people who do well deserve it, right? And those people who don't, well, that's their problem, right? This is the Ayn Rand school. I was much happier when I lived in a world that thought Ayn Rand was a crackpot. But, we are where we are. There are a lot of people who believe that this is the way the world should work. I think they are wrong. I don't share their belief system, but those who say it honestly, I believe, are honest, and I will at least respect them for their honesty. The other school of thought is the celebration of the job creators, right? This kind of job creation fetishism. Well, what we need to do in order to solve the income inequality problem is we just need to give more money to the people who already have it, right? Because then they're going to use it to create jobs. Well, I just explained why I don't think that's going to happen. There's a lot of evidence that shows that it's not happening. I think that to say that we can solve the income inequality problem by giving the people with money more money is the same thing as saying that an apple falling from a tree is suddenly going to reverse course and start to fly because we increase the force of gravity, right? There's no evidence to support it. It doesn't really conform to logic, and so it's a little bit hard to buy. And I honestly believe that the people who, there's a whole school of economics that's grown up around advocating this, and I honestly believe that the people who advocate this point of view do so because they don't want to pay more tax, but they don't want to feel like they're being cruel, and so they've invented this way of thinking like that not paying more tax is actually beneficial to people, but it is deeply, deeply, deeply dishonest. So then there's another thing we can do. The other thing we can do is we can solve the problem with markets, right? Now, you know, markets are failing us right now, but I am actually at core, I am a believer in markets. And, you know, I think market-based capitalism, I'll paraphrase Winston Churchill, market-based capitalism is the worst economic system ever invented by man except for all the others, right? But I think we think of markets in the wrong way. We think of markets as simply being about price optimization and profit optimization, but they don't have to be. There are many, many, many markets that optimize around other criteria, and we see them all the time, right? Markets behave in response to stimulus and incentives. If we say that the way we're going to measure everything is on the basis of short-term profits, then what our market system will generate is short-term profit at the expense of everything else, right? But if we were to say that success in our market system was based on something else, then our market-based system, if it were efficient, would generate that something else. This is what laws are for, and this is what regulation is for. So we have this free market economy idea that says, well, the markets should be free. There should be no regulation, no government intervention. Everything should just happen. And we know what happens when that occurs. The markets are driven by the basest human instincts, right? And in the financial markets, the basest human instinct is greed, right? And we end up with short-term profit optimization at the expense of every other characteristic. But, you know, I spend a lot of time with people who believe that we should have no regulation of markets and that kind of thing. I say, well, you know, are you a religious person? Yes, I am. Do you believe in the Ten Commandments? Yes, I do. Do you believe thou shalt not steal? Yes, I do. Do you believe that thou shalt not steal is a rule of the current financial markets? That stops everybody because you can't say no, right? Well, if thou shalt not steal is an appropriate regulation, why wouldn't an appropriate regulation have to do with job creation, right? Why is job creation worse than stealing, right? So, you know, just to toss out one very quick idea, and I'll move on to my final point and we can get to discussion, but, you know, we have a lot of talk about corporate income tax rates. Our actual corporate income taxes paid by U.S. corporations is very low. Our rates are not that low, but corporations get around them. We're very good at that. We talk, you know, there's the school of thought that says let's cut them to zero because that way corporations will create more jobs. That won't happen, right? They'll create more profits, won't create more jobs. What if we raised rates? What if we raised them to, you know, you could raise them 100, in my example, you could raise them to 100%. Corporate income tax rates 100%. But you get credits for creating jobs, you get credits for education, you get credits for things that build infrastructure, you get credits for all these things, and your credits can take your actual paid rate down to zero. Why would that be bad? If we did that, and I serve on a lot of corporate boards, I can tell you there would be a huge amount of money spent on how do we create more jobs, right? How do we do a better job at education? Geez, we're getting paid for that. We ought to do that. So I think the best way to solve the problem is to use our markets in their most productive possible way, but that takes a concerted effort to define rules and regulations and incentives that will drive markets to do the right thing like they used to when wealth had to invest in work. Third point, and this is the most controversial one. People like me have to be taxed more, right? We can maybe long-term solve the problem with better market incentives and better market constraints, but we can't do it in the short term, right? And we have let our infrastructure erode to a horrible point, and it's going to get worse. We're creating poverty in this country that is bad and getting worse. I mean, I could go on and on. You understand this as well as I do. That has to get turned around. It's hard for me to understand how that gets turned around in the short term if we're not willing to tax people like me to a greater degree and use the tax code, at least temporarily, as a way to substitute for the naturally distributive effects that industry used to have, right? So I'm going to end there. But my primary point is that the problems are, as I said, worse than Bill. Executive pay is a problem, but that's not the biggest problem, right? Stock buybacks, then we can talk about that. That's not the biggest problem. The biggest problems are the ones that I define, the secular disconnection or secular trend towards disconnection of highly concentrated wealth from widespread well-being, the erosion of the middle class. And what it's going to take, and here I'll end exactly as Bill did, is it's going to take the will to fix the problem. It's going to take a change. I think it's going to take a restoration of societal norms to what societal norms used to be. But we're only going to be able to solve the problem if we understand that this is a societal problem, and it's going to take us as a society to do it. Thank you very much.
Much deeper in the sense that are jobs obsolete? And that seems to be a profound challenge, is how do we come up with creative ways to find employment? Because I have a millennial daughter, and I know that she's fortunately a medical student, but her friends are entering a job market that's almost non-existent. So that's really scary.
It is very scary. I have 3 millennial daughters.
Mm-hmm. Wow.
One is a second grade teacher in a highly disadvantaged public school system, and it's very hard for her to live. Right? One is in law school; she'll do fine. But this is our problem. I think that if we think about things as we had a temporary financial crisis. We didn't like the George Bush presidency, but we'll like the Mitt Romney presidency better. I mean, whatever it is, it's a short-term problem that's going to go away. I don't think we can fix it. I think if you think about it as we are going through the same kind of transformation that occurred as when we moved from an agrarian economy to an industrial economy. And the agrarian jobs went away. The percentage of the population that earned their living farming used to be incredibly high several hundred years ago, and now it's essentially zero, right? But what did we do? Well, the Industrial Revolution helped us quite a bit, but there was a social contract during the Industrial Revolution that was enforced by the necessity, as I mentioned, for wealth owners to build trained workforces, right? In the information revolution and what's going to follow the information revolution, we're going to have the same dislocation, the disappearance of old-style jobs and the need to create new-style jobs. But my point tonight is we may not have the same de facto incentives for the owners of wealth to create those jobs. So I think this is my point, that we have to understand this as a problem that we have to either decide to fix or not fix as a society. And if we decide to fix it as a society, we're going to have to accept the fact that the remedies are going to be different than what the remedies of similar problems have looked like in the past.
So, Bill, we know that the job creators are buying back their stock and not creating jobs. Any thoughts on how you create jobs?
Yeah. So I think there's a lot of connections between what Andy was saying and what I was saying. Because I was not arguing that it's just that the problem is not executive pay per se, but it's fact those people are in charge of corporations. If you take the 1,000 largest corporations, about 27% of employment, about 33% of payrolls. Okay, and then a lot of other companies depend on what those corporations are doing. So if Dell is not doing well, there's a lot of other companies that aren't going to do well, et cetera. Okay, so now. When those companies are successful, they not only hire people, they train people, they develop people. Now, those people may go to other companies, and they may pursue careers where, in fact, they accumulate experience, et cetera. But it's fundamentally important, then, that they be able to pursue careers over a career, at least until they get and people live longer and be able to work. Now, when they do that, Andy used a phrase, which that labor becoming a commodity. We cannot have a successful economy, and never would have had a successful economy if labor was a commodity. In fact, I was thinking just as he said that it was 1974 or something like that. I gave a talk for my first job at Harvard University. It was called The Commodity Status of Labor, where I made this argument that if labor was just a commodity, you could not have a successful economy. Why? Because you can't have innovation as labor is a commodity. You have to have people working together, people sharing their knowledge. It's an innovation I call a cumulative and collective process. Okay, and so we have to figure out how to create the organizations that do that. Now, the old companies did that, and then the government supported them. But that's gone, and I agree that that's not coming back. I agree that globalization is a process that has to go on. The notion of I think you should get rid of tenure in universities. The notion you have a career in one place is not the way a society can be run anymore. But the notion, though, however, that because of automation, there can no longer be creative jobs. There can no longer be thinking people. I mean, that I won't buy. And there are so many things that we want people to do. We want our children to do. We want everybody to do that are out there. And we wouldn't have any of these technological wonders if in fact, that wasn't the case in the past. And we're just not recreating that.
So I think one of the problems is that if we look back, I think you only have to look back to the 1970s, right? Innovation was a widely shared pursuit within corporations, right? When the ability to go from an idea to a finished product that worked and had successive generations through its lifetime required the mastery of all of the disciplines required to field the product, then yes, innovation was something that was required company-wide, right? One of the things that's happened in a lot of industries as a result of technology, as a result of increasing development of global competencies, great competencies that live elsewhere, and is that the path from the initial inspirational, innovative idea to the finished product has become streamlined, right? So you're absolutely right that you can't have innovation without somebody innovating. You can't automate it away. By definition, you cannot automate it away. Innovation is the thing that hasn't happened yet, right? But if it only takes 5% of the world's population to innovate 95% of the world's innovations, then the other 95% have a problem. And that's the point that I'm making, which is that the natural mechanisms we had to share the value of innovation, because innovation had to be practiced in a widespread way through corporations, that is disappearing.
Yeah, well, let me just then to the other point is why is it disappearing? Part of the reason it's disappearing, and this comes out of the way economists think about the economy, but it's also a phrase that, a point that you made, Andy, and that is that we live in a market economy. I argue markets are great, and we love markets because we can go and buy whatever we want. We can change jobs, which is great. We can borrow money and even start companies. So markets are a great thing. But markets are not what drive the economy. Markets are outcome of a successful economy. What drives the economy is organizations. There's three types of organizations. There are government agencies, there's business enterprises, and there's households. Households are organizations, one of the most profound organizations we have, because they have to create this product over maybe 20 years. Now it's 30 years, and hopefully that person will then be in a position to fend for himself or herself. So these are organizations. And when economists talk about households, they then quickly collapse that to the individual. It's not an individual. Business organization, even I'm sure you well know, a company of 50 people or even 20 people is a substantial undertaking. Figuring out how to keep those people employed and how to actually create value with those people is not something that just happens. It takes a lot of insight and a lot of investment of capital and cooperation among those people, et cetera. There's a lot of things that go into it. That's an organization. And in the United States, we've had organizations, but not just small ones, but large ones, for over 100 years. So a guy I worked very closely with, died a few years ago, Alfred Chandler, kind of often called the Dean of business history at Harvard Business School. He ended his career. He wrote a book in 1977 called The Visible Hand. It was called The Managerial Revolution in American Business, The Rise of Big Business. That had all happened, if you read that book, by the 1920s. Okay. That's what drove the American economy, plus government investment in everything going back from land-grant colleges, railroads, aviation, internet. You can go across the board. Anything that we do that is complicated, the government's been there. And these organizations drive the economy. Now, once those organizations are successful, then it's not so hard to change jobs, or it's not so hard to borrow money. There's money available. And so we deregulate the economy, and we let those markets take over, and that's where the problem begins. So we have to really understand the economy as an organizational process and how those organizations need to be built and have to be continually recreated to invest in these new technologies, in these creative capabilities. And there's no doubt in my mind that there are enough problems we need to solve with technology that it's not going to be everybody, but we could occupy much more than 5% of the population.
So one of the things that you were credited some of our new economic models to what's happened in Silicon Valley. And I think I'll happily take my share of the blame, or I'll appropriately take my share of the blame for that. But one of the things that we have really innovated in Silicon Valley is we've innovated the virtual corporation, right? And why have we innovated the virtual corporation? We said, well, our job, and I can tell a lot of stories about what it's like to be a corporate director, but our job we have been measured by maximizing shareholder value. That shouldn't be how we're measured, but it is how we're measured. And large organizations are very difficult to manage, right? And one of the insights that I happened in Silicon Valley was, wait a minute, if our innovation if the ability to realize our innovation is becoming increasingly diffuse around the world, then it isn't necessary for us anymore to control that ourselves. And we can go buy that stuff. And in fact, if we are buying that stuff, then what we really want to do is commoditize all the stuff that we're buying, right? And we want to create as few jobs as we can possibly create here in the United States, where it's expensive for us to do it and where we then have to make the investments in training people and all of that. And we want to commoditize all of the other jobs. I've thought about, the current presidential campaign has actually forced me to think about whether I've actually been a job creator in my career, because I do basically what Mitt Romney did, right? And that's been basically my career, right? And I've thought, and he said, I've created 100,000 jobs. So I've thought about this, and I've thought, well, how many jobs have I created? Well, first of all, I don't think we've created any jobs. We're all more job mover arounderers. I don't think we create them. But if I've created paychecks for people, how many paychecks have I created? And the answer is, I think I've created 100,000 paychecks at least in my career, right? The unfortunate part is that 90,000 of them are in Taiwan and mainland China. Right? And it's precisely because we've been thinking about how to keep our organizations small, right? And we have been insanely innovative. And so this, again, is the problem, that the old mechanisms we had to spread the value of that innovation, I'm having trouble seeing how we're going to do it again, even though, like you, I'd like to find a way.
Yeah.
Andy, I'm going to start by directing this at you. I'm John Taplin. I run the Annenberg Innovation Lab at USC. So the big Silicon Valley corporations like Google, Apple, Microsoft, all have at least $80 billion in cash on their balance sheets. So it says to me that they cannot find enough new things to invest in, even though they have become virtual corporations. Apple doesn't even make its goods. It has Foxconn make them. And I noticed that Brazil made Foxconn move a factory to Brazil in order to do, we might make Foxconn move here, But anyway, what does it say to you? And then maybe they're just using all that cash to buy back stock so they can make their stock options work for their employees, but then they just become like a bank.
So it's a very good point. So first of all, you're absolutely right that the problem with that cash is that it is more than they know how to productively invest, right? So why does it just sit there? Well, why wouldn't you unproductively invest it, right? Why, because there's some gradient, from the most productive use of that cash to the least productive use of that cash. And why have they put the measurement point exactly at the point they have, as opposed to say, well, we got a lot of cash. There's a lot of stuff we could do. It might not be as profitable as what we're doing now, but it'd be pretty good, right? And the reason is because the performance of that corporation, like every other U.S. corporation, is measured on profit growth. Right, and so every U.S. corporation is constrained in the investment of its cash by its need to satisfy its shareholders by maximizing profit growth. Right, this is my point about if we optimize markets around profits and profit growth, we're going to get what we got. Right, so that's one reason why they're not investing the cash. They can't. The market would punish them for investing that cash. Right? Why do corporations buy back their stock? Well, you sit with all this cash on your balance sheet. If you have the cash in the U.S., most of these corporations, most high-tech corporations, have most of their cash outside the U.S., so they're constrained in how they use it anyway, because even if they were to decide to invest it, those investments would have to be outside the U.S. That's a whole other story. How do we get ourselves there? Why do corporations buy back stock? It is the most cost-effective way to give cash back to shareholders. Right? Because dividends are taxed, even though they're taxed at a low rate, right? But buybacks are not taxed. So it's a tax-free transfer of wealth from the corporate or value from the corporation to the non-selling corporate shareholders. That's why they do it. Is it a good thing? Not necessarily, right? But it's the most tax-efficient way to give the cash back. So I agree with you. I think that, in fact, I participated with Z. Holly at USC on some work she did I'm looking at innovation strategy, and one of the things that I talked to her about was that if we created incentives, and the government could create incentives to allow that cash to be used for innovative purposes, right, we could get a lot of value out of that cash. But that is, again, an example of how we need to use markets. We need to create different incentives in order to free that up.
My area is neuroeconomics, and I have some concerns. I noticed you had makers and takers, but you didn't have fakers up there. And basically, what I see is an ABC. Advertising, truth in advertising certainly is not talked about. FAT, flawed asymmetrical thinking, and contracts. For example, the MSV is not a contractual obligation whereby the stockholders have a right in terms of value. My concern is the exaggeration, especially in advertising. And if you could talk about contracts and ownership. For example, the sports leagues do a very good job in terms of equity. How come there are no better contracts whereby I was taught as a kid to own, and essentially we're talking about jobs where someone is working for someone else. Could you talk about how we could contractually have better opportunities for the people going into a corporation to get a piece of the pie?
Okay, well, first of all, I don't think you ever build an organization, economists call them incomplete contracts, by having complete contracts. In fact, for example, I've studied the Japanese economy a lot. You have something called permanent employment. Actually, I was a permanent employee in Japan, but I won't go into that. It's not a contractual status. It's a norm. And then you have to ask, why does this norm persist? Why did companies in the United States employ people for a career, and that was the expectation on both sides, even though there was no contract to do that? There's a set of norms, and I think that's really ultimately what governs the way in which resources are allocated, things get done. Now, the shareholder value is a fundamental problem here. It did not exist as an ideology at the beginning of the 1980s. So you had the United States, the world's most powerful economy with the world's most powerful companies, without the ideology of shareholder value, without having to keep shareholders happy. And they kept shareholders happy, however, by growing and by paying dividends. Okay. The ideology came in. I saw it come in at Harvard Business School during the 1980s. It wasn't there at the beginning. It was there at the end. The vast majority of business school professors did not believe it. But it dominated because it mainly fit with what I call this myth of the market economy, the idea that markets are driving things. And one thing was added to it, and this was by what's called agency theorists. The most well-known is a guy named Michael Jensen, who I clashed with at Harvard Business School. He ultimately got me banned from that place. That the only people who take risk in the economy are shareholders. Now, I would agree that if I start a company and I own the company and I put my own money into it, I'm taking risk. But then I'm also asking other people who come and work with me rather than going with established companies. Lots of people who take risks. And if I start using government resources, knowledge, even hiring people from university, you've been funded by the government partially, the government taxpayer is taking some of the risk. Well, they took this leap and they said the only ones taking risk in the economy are shareholders. And ultimately that was public shareholders because that's what most shareholders are. Okay, now the leap there was to say, why is nobody else taking risk? Why are workers not taking risk when they work hard today, not for the pay today, but because they get tomorrow? And in fact, if you have an innovative company, you don't want people who just work hard for the pay they get today. You actually want people who work hard for their pay they're going to get tomorrow in their careers. Why, when we fund things like the National Institutes of Health, which is $32 billion a year, $800 billion in current money since it was started in 1938, why aren't we credited as taxpayers for taking risks? We are. That was just assumed away. Why? Because everything else was a market. Everybody was getting paid their market price, except shareholders who did not have a guaranteed return because you could or could not pay dividends or money. Okay, it was a total fabrication in terms of how, in fact, innovation occurs, how wealth is created, that has become totally dominant, and it's not a shareholder ideology really, because I don't own any shares, but some people do, a lot of people do. We don't have any power if we do. That's why I don't own any shares. It's a managerial ideology. It came in as something that was very convenient. If you're at the top, to say, I can fire people, I have no obligation to people, I don't have to pay taxes, and it fit in with the whole ideology we see all around us that is swamping us politically. And it all comes back to that. It wasn't there before that. And there's a whole lot of things that brought it in, but it isn't something that's been around forever. And and a lot of legal scholars have written about this as well, that it's not something that's legally mandated either. So I see it as absolutely fundamental, this notion of who the economy needs to be run for and who corporations need to be run for. And it's not something that's discussed very much.
So, I think that's a really good point. It really gets to the point of what are corporations for, right? If corporations are for the creation of wealth independent of where that wealth is and how it is consolidated, that's one thing. If corporations are a means by which prosperity can be spread, that's very different. But we have to ask the question what it's for. Your point about managerial mentality versus shareholder mentality, I think, is a really good one. I am a little bit, having been in the business world my entire career, I'm a little bit cynical about management, and I've worked with some fantastic management. But everyone responds to incentives, right? And why did the managerial mentality up till 1980, let's say, establish a different contract with its workers and with society than the shareholder mentality does post-1980? I think there are a lot of reasons why. But one of them is tied to globalization, which is that if you go back in 20th century America, right, and certainly the post-World War II industrial boom in the United States, where was the biggest market served by U.S. corporations? It was in the United States. Right, so managers of those corporations had a tremendous incentive to spread wealth in their largest market. Right? But as other global markets have grown, and as it's much easier for U.S. corporations to access those markets because laws in developed countries have been liberalized, and because of communication and transportation technology giving us access to those markets, and because of quite a number of things, all of a sudden the health of U.S. corporations is not necessarily dependent on U.S. consumers. Most of the companies I invest in sell less than 30% of what they sell in the United States. Right, so the managerial mentality, I think, has changed even without a lot of this kind of shareholder abstraction.
Yeah. Okay, so you say you want a revolution. You both seem to agree on this, and most of the people here. Oh, this is very strange. Most of the people here are willing to change their thinking. What I'm curious about is how could you change the thinking at that very top, unbelievable compensation level? What motivates somebody who has 2 yachts that they can't drive at once? And what is Is it just greed? I mean, how, you know, what is their thinking there? Do they really believe that they're doing right? And can something profound change there where it would do some good?
So
I'd actually like to direct that, yeah, to you, because you have experience of these people. What motivates them?
Yeah. So listen, here's the thing. First of all, it's impossible to generalize, because on the one hand, when we think about people who are super rich, you know, we can think about Bill Gates, who is, you know, certainly the greatest philanthropist of my generation and maybe the greatest American philanthropist ever. Right? And he is motivated by a desire to use his wealth and his smarts and his intelligence and his organization to solve big problems in the world. And I don't think we can ask for more than that. On the other hand, and I could start naming names, but I won't, we have a lot of other people of comparable wealth. And what scares me the most, I told you I was going to depress you, what scares me the most is that at that level of wealth, people can float above society. They don't need society, right? Because they can have private society and don't have to suffer the ills, and even national boundaries don't make that big a difference. If I don't like, you know, the water in the United States, I can go to Fiji, right? It's pretty easy, and so, you know, it's a very tough problem if we're depending on people who don't fundamentally need society in order to improve society. It's a very, very risky bet. So I think we can only do two things. I mean, you know, I'm not a sociologist, I'm not a historian, but, you know, most revolutions I'm aware of started bottom up. They didn't start top down, right? And so I think we got to figure out how to empower people. And, you know, we do still, we live in the United States. It has become increasingly a plutocracy, but we still do have voting mechanisms, and we still do have the ability to give voice to people who are not the plutocrats. So I think one is we've got to figure out how to empower the rest of society and argue about the right things, right? And then the second thing we need to do, and I you know, maybe I have romanticized periods of time, but, you know, in which I didn't live. But I think we need to shame people. I think the job of society is to shame people who otherwise wouldn't be altruistic and otherwise wouldn't have the greater good of society, into simply not being able to act the way they act. If we celebrate Ayn Rand, we're not exactly doing that. But anyway, that's the best I got.
From what I've understood about what you both have said is that free markets on their own, without any regulation whatsoever, cannot be trusted and will inevitably lead to harm if they operate, you know, as they want to. I guess my question is, well, I was actually a little surprised neither of you addressed what I think is a huge problem, a huge cause of the recession that we've been going through, and I think that's the Federal Reserve and their power to manipulate interest rates and keep them way too low. They keep the interest rates below levels that the market would allow, and they can just print as much currency as they want, and they are not responsible. They're not accountable to anyone. I think that is a substantial problem since the currency is tied to everyone. And yes, you mentioned that this financialization of the economy is responsible for concentrating it at the top, but if they can just print money, which drives up food prices and gas prices, doesn't that also cause the middle class to disappear? I'm a little skeptical that getting the government involved will fix this problem, as they're basically trusting all the money and trusting our currency in the hands of, I would almost say, an oligarchy in government has devalued the currency. So I'm a little skeptical to trust them. How can you allay my concerns there?
Well, inflation isn't a big problem. Inflation's not a problem. I mean, it used to be a problem, but it's not a problem now. And the problem is jobs, and the problem is that we're not investing in jobs. We're shifting all of the risk onto families to try to support themselves and their children, to try to get jobs that aren't there. And now you make the argument that there's some technological reasons why they can't be there or they'll never be there, but I don't buy that. And it has nothing to do with the Federal Reserve, in my view.
So the Federal Reserve has a dual mandate, right? Its charter is to control inflation, and a little bit of inflation right now wouldn't necessarily be a terrible thing, and to manage to as close to full employment as we can get, right? I think the problem with the Federal Reserve is not lack of oversight. There's plenty of oversight. The problem with the Federal Reserve is not that printing money is always bad. It's sometimes very, very good and extremely important. The problem with the Federal Reserve is that it's afraid, for whatever reason, or it's, to operate to the second part of its mandate, right? And if you see what comes out of the Federal Reserve now, it's all about, we're only watching inflation. We'll keep the money supply high until we see signs of inflation, and then we will moderate. But you don't hear anything about employment. And my personal view is the Federal Reserve is shirking its responsibility. It should be printing more money. It should be doing more of the things people are criticizing it for.
Hi. I know that time is getting short, and I'd just like to leave you and everyone in the room with an observation. You keep talking about globalization. The free flow of capital without the free flow of labor is not globalization. It's corporate welfare.
Any comments?
Well, there actually is a lot of free flow of labor. It's into the United States from a lot of from Asian countries on various types of visa programs like H-1B, L-1 visas that allow people to get educated and to get experience here. And I think actually that's been good for the world in terms of what's come out of it. That is, educated and experienced people, I think, are good for the world. But I think that that's been done in a context where, in fact, people who have jobs in the United States and who have the experience are just put thrown to work. Often we have lots of stories of them actually training people who are going to replace them. And so it all comes back to the corporation who has created value in the corporation and how you put that value back into the economy. And just one example that I sometimes use is there was a press conference in 2005 when globalization, people had started getting excited about it in 2003, and it was still on. And Craig Barrett, who was the CEO and chairman of Intel, who's a great guy in terms of wearing two hats. He's on every kind of public commission, or he was, on how to make America competitive and all the things you had to do. But then he was also running the biggest semiconductor company in the world, which is a huge, huge beneficiary of decades and decades of government investment in computer technology, et cetera. Now, not to say that Intel didn't do a lot itself, but it was a huge beneficiary. Okay, so as the CEO of Intel, Intel just does whatever it wants to do with its money, and that's, in his view, being responsible to shareholders. So Intel on its website shows you their cumulative buybacks, which are now, since early 1990s, probably about, I think about 80 or 90 billion. Okay. That press conference was asking the government to spend more on nanotechnology research. They were saying that this was essential to and he was making the argument, I quote him, that this is essential to future competitiveness of the United States. Now, the United States does spend money, or we do as taxpayers, on nanotechnology research. There's now it's about $13 billion since the National Nanotechnology Initiative was started in 2001. Between 2001 and the present, Intel has probably done about $60 billion worth of buybacks. That 1 year when they were making that argument, they did $10 billion that 1 year. Okay, so all you need to do is start with that company and say, part of that money belongs to us. Okay, that has to come back. And I'm writing something on Apple now because I'm saying this is where Apple is now. And I don't think Steve Jobs would have done this, but if you really want a leader to take the lead, it's not just the Buffett rule. It's people in these corporations saying that money that we're making did not just come from us. Yeah, our employees create it, and there's a lot of employees that we don't find useful anymore. Let's figure out, even if it's quasi-public services, way that they can be useful. But let's also say that's going to go into the fund for the future. And it's not just shaming companies, it's creating ultimately rules. Because I think what happens is you start having a movement, but then you have to actually say, okay, this is the way things are done. And if you don't, and ultimately they do become regulations. And I think there should be regulations on all major corporations that when they make a lot of money, that money comes back into the economy. There is one person in Massachusetts making this argument now, Elizabeth Warren, and hopefully she'll get elected.
Last word, Andy?
So I think Bill is exactly right, and it comes down to what are corporations for and what are the incentives that we want corporations to operate to. The problem with globalization, if you think about globalization and its limit, in a perfectly efficient global economy, the standard of living would be the same everywhere. Basically, what we've done, what U.S. corporations have done through globalization is export our standard of living, right? And as the standard of living, if you exclude the top 1 or 2 or 3 or 4%, standard of living in places like China has been growing fairly substantially, and in many other places in the world. But it has come at the expense, because of the mobility of labor, because we're able to it costs us less to support a rising standard of living in China, for example, than it does to do the same thing here. So if a totally globalized world would have the global standard of living settle somewhere that's in between, the standard of living that we've enjoyed here in the United States and the standard of living in sub-Saharan Africa, then we have two choices. One is we can just let that happen, right, and our standard of living will fall. The other is that we do exactly what Bill described, at least in the general case, and we assert rules that our corporations, our society has to operate to, and our government has to operate to, in order to do those things that would prevent it. I think that's our choice, right? And I think those, unfortunately, I think those are only two choices.
Well, I thank both of you gentlemen for coming here.